S&P hits all-time highs, but we're seeing a few cracks here. We're going to dive into what the breadth of the market is telling us, as well as relative valuations, multiple time frames, and multiple sectors. There is a tremendous amount in today's video. I get very granular, and I also try to get you to understand how to look at this stuff from different perspectives. So we're going to just jump right into it. Subscribe and click all notifications. 27.5% of you that watch these videos do not subscribe, and they are all linked together and they come out at different times. Let's get to it. There's definitely parts of this you're going to want to watch again because there's a lot in here, but let's just jump right into it. If we look at the monthly right here in the S&P, we could see that we hit the higher high. We could see the complete blow off of April. And we're going to get into the four horsemen charts for a second, meaning these four indicators that I look at for a more long-term basis. You could just see that here you are with the MACD, you're hitting a higher high, fits right in line on the monthly. If we go through this, right, and take a look at this, as long as we are above the rate of change and you're above zero, I don't really care. We just want to make sure that we stay above it and we don't break that zero line. Because once you break the zero line, you have problems with the rate of change. And it's very rare to do it on a monthly basis. You didn't do it, so we're okay. As far as on a monthly basis with RSI being over, I don't really care as well. You can stay over for years on the RSI that way. So it's not something when you go back and take a look at it, it's really rare for it to kind of crack as it did back here in 2002 or even crack back here in 2009. But I don't care about that. I care about, is it rolling over? And it's not. Are we getting some kind of divergence? Because that could lead to some kind of pain. And we're not getting anything like that. So on a monthly basis, I don't see the issues. Now, if we go and take a look at stochastics, you had your little dip here, and now you're right back above it, and this is slow stochastics. If we drop this to the weekly for a second and do the same exact thing, and all we're doing is just taking a snapshot of the different time frames, we can see the undercut, the flip, and the push on the MACD. Don't really see much to do there. Rate of change looks fantastic. There's nothing to say there. Again, as long as we're above the zero on rate of change, that's all you want. And then here we have the RSI, and you're over on the weekly, but I don't see any kind of turn in it, so I don't see a problem there as well. Go into stochastics, and you are starting to slope down, but you can slope down and just go sideways for a while. And then just to get a sense of the daily, and we can see where we're at. I want to go through these and just get a sense of what they're telling us. But then we're going to have to dig really into this for a second. You can see exactly where I'm going with this, hopefully. See how you're starting to turn a little negative there? I'll show you what I mean by this. Let's drop it down. Let's get rid of this. So we're not hitting that higher high and we're flattening off. And that tends to happen on the RSI when the magnitude of the move, because that's what RSI does, is not as great. And that's because the breadth is not as great. Now, we could run the same thing with IWM, and we could run the same thing with the NASDAQ, but I don't find that as helpful as some of these other charts. And what I see going on there, in a sense, is absolutely glaring. So today's video goes broad and deep. I put a lot into it. So you're going to find parts of this that you're going to want to watch again, because I'm not going to go over the same concept. But I do want to point out this, because it's really absolutely glaring. If you look here, the NDFI, and what is that? That is percentages of stocks in the NASDAQ 100 that are on a percentage basis above or below their 50-day. And it's called NDFI. And all I did here was just turn it into an indicator. What is this telling you? Well, if I'm below 50, that means 50% of the NDX is below their 50-day. That's not great. If you ever looked at the performance of the market, you'll note things along the lines. Here you're on November 23, and you break above the 50, and you go. Anytime that you're breaking above the 50, you go. Anytime you're breaking below the 50, you fall down. So anytime you're above the 50, you go. Anytime you're below the 50, you fall down. What I have here are situations where you're either declining in the breadth of the market, or it broke the 50 and hit a new high. I'm not going to go back and show you this over 20-something years, but it's really interesting to see. So what we have here is we have the pandemic. So I have a hard time with this one and using it as a statistic, because one day we're all out living our lives, the next day there's a global pandemic. So you're going to have that instantaneous move that's going to affect the market. But if we went back to an area, for example, back in 2018, where we got tariffed the first time with China, and you could see right there, we broke this level. And as soon as we broke that level, and we'll spend a second here to zoom in on it, and you see how they're walking you down on the breadth of the market the entire time? See how the market's going higher? And then eventually you just break the 50 line, even though you're hitting an all-time high on the market at the time. And what happens? Bam, Matumbo. That's it. You're done. You can see it here as well. You hit a new high on the market, and then all of a sudden you break down past that 50, and you have a correction. It is not the end of the world, and I want to be really clear on this. They can be very short. So in this example, you only have a drop of about, 23%. That's a pretty big one. But in this case, you have a position where you're down about 10%. Do I think something like that's coming? Tactically, I think you need to be prepared for it. I think tactically you have to think about the fact, and we're going to get into these definitions today. When I say tactical, strategic, cyclical, secular, I want to give you ways that you can actually use those. When I use those adjectives to describe things, how you should be looking at it in your mind. It's very helpful. I mean, it's one of the things where I'll say something and then people will say, but you said not everything that we're going over, guys, is going to affect you Monday, Tuesday, Wednesday. So you have to think about it that way so that when you get these dips, that you can take advantage of them. But if we are to look at what we're seeing here, you're climbing higher on a wall of worry, to me, of where this is getting weaker and weaker. So what we're actually doing here, if we took a look at it, is we're actually sloping down. And you can see that slope yourselves, and you broke 50 and you hit an all-time high. That's not really where we want to be. So the breadth of the NDX 100 is getting worse. What must happen is the breadth needs to get better. So we need to monitor this and see if it's going to get better. If it doesn't get better, well, then we have a problem. And then eventually it's going to roll over. Now, where does that roll come to? Again, I'm not saying that you're going to fall off a cliff, but it's a great time for you to look at positions, in my opinion, as always, and just look and say, hey, how much risk am I really willing to take here? And when we start to see things like 5% or 6%, and people think that's the end of the world, that's nothing. But remember the rule of three. So if the NASDAQ will drop 3%, that means a sector can drop 3x that. Meaning if the NDX drops 3%, then the stocks could drop 3x that, or 9%. And then the other part of that rule is that a stock within that could also drop 3x. So then you could have a stock in there that could drop 20%, right? Just remember that rule of three. It's real simple. But where I'm going with this is, I think you need to be a little cautious with some of this stuff and what we're seeing out there. And there's a couple other graphs. And that doesn't mean to not trade them and the great crash is coming. I'm not saying any of that. But I do think that when you look at the McClellan summation and we look at these areas and we're seeing that high and then you hit this area and here and now you broke your zero line. When you break your zero line here on summation, and this is McClellan summation, I'll show you this in a different format because some people like that better. You can always comment on the format that I'm about to show and say, hey, I like that graph better. It made it super clean. But if I break that zero, all I have to do with it is just go through it and say, okay, well, this is where we broke the zero on both. Was there anything there? No, we rallied for a little bit and then we finally broke it and then we came in, okay? And all you're doing is just looking at what's happened in those areas because this is where you're at now. And is there something that we have to be concerned about? Well, here we just went sideways. So do we really have to concern ourselves with it? Here we dropped. Here we fell off a cliff. So it doesn't mean that you're going to completely implode. It just means that you're probably going to go through, at a minimum, some kind of sideways action. And again, what you're looking at here is you're looking at summation in regards to the New York Composite, which is really how you're supposed to look at summation. Here's a different graph of it to put it in perspective. So when we break and you break hard, obviously you hit an extreme level. When it starts, you just want to watch because you don't know, am I going to get some kind of little blip and then we're going to go back up? Or is it going to start expanding to the downside? And you can see if it expands, it kind of can just stay there, right? Like you can kind of crack and just stay there. And then you can also just go sideways and then it can correct itself. Both are available options. Just because you break a zero line on the McClellan summation doesn't mean the sky is falling. But if you start to see deterioration in it, then yeah, you have a problem. And I don't know what you have yet. I have this. And I just broke the zero line. Now, does that remedy itself? If so, how? I'm not fully aware of that yet, and I'm not fully aware of how it would do that just yet. If we look at the market in and of itself, we would say, well, let's look at the breadth. All right, well, here's the 5, the 20, the 50, and the 200. And that's in regards to the S&P. We can just see right in here that the 5 days rolling over a little bit, the 20 is starting to point down, and we don't want the 20 to break 50 because that's the first sign that we have a problem. And what we've noticed here, and what I think you should be noticing, is that the breadth is getting worse. So let's get rid of the 5 for a second, and we're just going to look at the 20. And you probably already saw it, but I'm just going to point it out for you just in case you didn't. So there's the 20, and then here we are on a percentage basis, and let's just mark off from where that hits. So what we have is we have less stocks in the S&P above their 20-day moving average, but the market's going higher. How about the 50-day? And you could see it right here that we're going lower, but at the same time, we're going higher. And then you could see the 200 and you could say, all right, well, you're pretty much flat. So what does that mean? You're probably going through some levels of rotation, which I think is pretty healthy, but at the same time, you're losing names. The names are getting worse. Obviously, you're going to break your 20 before you break your 50, before you break your 200. So we would look at this and say that you have a bearish divergence, not only on the NASDAQ, but also on the S&P as far as breadth and the ability to hold those averages. And you could see that here as well. If I chose not to use a rounding and just drew the line, you would see that you'd have the same divergence here. And I think that's super important to get. So we are losing more names, and this is just a fact. Now, if we look below, what this graph is showing us is new highs and new lows on all the ETFs that are out there. And if we look at all the ETFs that are out there, let me just get rid of this for a second. If we look at all the ETFs that are out there, we'd have to say, well, that's where all the inflows are going. We want to make sure that those ETFs are hitting new highs. Well, those ETFs have peaked, and they peaked around July 10th, and since then we're going higher. Does that mean that we're not buying ETFs, and does it mean that we're buying individual names? One could argue that. And so you could look at this and say, does this really matter? I would argue that it means that you're setting yourself up longer term, and this would be longer term, that you just might go sideways for a little bit. So you have a period in here where we went down considerably until we fell off a cliff. I think the breaks are interesting on the graph. So in other words, it's new highs, new lows of ETFs. And if we look at where the breaks are, those breaks tend to be marking levels of where we tend to see that top. And I don't know that you're going to break this. I don't have a clue. Nobody does. But if we look there, you can just see mark it off. That marks a high. And it does over and over again where you see those breaks where they mark levels. So the real use of this, in my opinion, is the break where they go from net outflows, net inflows, which would be the only way that you could have more selling down, right? The only way you're going to get more ETFs selling down is if you have more outflows than inflows. Other than that, it's not going to happen. So if we look at it from that standpoint, I think you're better off looking at it from there. I do find it interesting to just look at the fact that, and if we clean this off for a second, you'll see where I'm going with this. This kind of drop, it's not normal when we look at this over the past year and a half. You don't really see that, right? Matter of fact, like you look at like 21, like this is kind of crazy, but you look at 21 and all of a sudden they just poured in. And the flips are of interest, and so are they when they come down. But this kind of drop that you're seeing in it, that's what really stood out to me. Like, why all of a sudden are all these ETFs out there? Why are they all breaking? Why are we all of a sudden getting less new highs on the ETFs if there's so much money coming into the market? And I think this really goes back to consolidating what we said before, where if you look at the market, the breadth here, it's not great, so that you have less names that are going higher here, and you have less names that are going higher here. There are economic data points, such as economic uncertainty, that are leading to a fact that we might start seeing more money come in. Now, with the recent economic turmoil between CPI and PPI, you would think that things are actually economically getting worse, and that's not really the case now. And this is super important to get, because for our standpoint, we want to make sure on how things are really going out there. And I do agree with the way that BLS is looking at this. And I want to just say this about whether it's BLS or Fred. I don't think the issue with Fred or any of these places is the quality of the information. This is my opinion of it. I think it's more the timeliness on when it's coming out and how they're allowing these revisions to take place. And it makes it harder to make a decision. But for the purposes of this, and you're welcome to comment on that. On the purposes of this, you were just looking at the Economic Policy Uncertainty Index. And what this tells you is how uncertain do people feel about things out there right now. And from my standpoint, they feel pretty, they're still pretty out there. They're still pretty little concerned. And I'll show you what I mean by this. You did drop from this 450 level if you come all the way across here. And now you're down around that 300 level. Okay, so from March 2025, where we got liberated, we're back down to this, 300 level. Let's look at that in context for a second. Now, this is directly from Fred, and just so you understand, you can go to the site yourself. and play around with this data. It's completely free. And it's probably not the worst idea in the world to go and take a look at some of this stuff so you can get a look at the macro leg of the stool. But again, you can see that 450 level, let's call it, and now we're at that 300. If you look at this, you can see I did it and set it for 10 years, which is right up here. And if we just take a look at the 300 line and come across here, well, this was the pandemic. And even though we're down at a level from where we were, you still are right at the crisis level where you were with the REIT, when we started thinking we were going to lose REITs, when we started losing commercial banks, when we started losing the regional banks, this whole area. That's where you're at right now. And then COVID. So just understand how much more could this economic uncertainty, when this starts coming down further and further, how much of a driver is that going to be for the market? Do we see money come out of money markets and go into stocks or into housing? I personally think the only thing that's going to get that to happen is going to be a drop in interest rates. But I'm very interested in what you guys think about this. So how much more uncertainty can we take out of the market right now? You know, we have the two wars. If those wars end, that would take some uncertainty down. If we start having policies that are put into place, that would take the uncertainty down. The new Fed chair, that's going to take uncertainty down. The rate cuts, that's going to take uncertainty down. The question from an economic policy standpoint to me is what's going to take it up? I don't see anything. Now, to put this in the broad context of looking at this over a maximum time frame, and I do think it's helpful to look at this. This was the greatest that we've ever had. And the only time that you've ever had anything like this, if we come straight across, was 9/11. That was it. And just think about the context of that. And so also, if you're looking at this from the max, it goes back to 85. You're going through the 1987 crash. You have a recessionary period with the Gulf War. And of course, you have a bunch of other, the Gulf War. You have a bunch of other things, COVID, the regional banking crisis, et cetera, et cetera. Russia, this is when Russia defaulted on their debt and everybody thought that they were going to have to go get the battleships to go get paid. It's a whole thing. But when you're looking at this, you're above all of that. And now you're back to the level that still ties you with, 9/11, the great crash of 1987. You're not in the meat of the move. And I think that this is super important because the one question that I keep getting asked about is people say the PEs are high. PEs are relative. And to me, from a relative standpoint, you need to look at the bond market. You need to look at the dollar. You need to look at how much money on a percentage basis is sitting in money market accounts. And then that determines if it's high or not. The one thing I would say about the PE of the market relative to not being at zero interest rates, that's pretty interesting this time around. So is this market expensive? Why is there so much money on the sidelines? All of these questions. Where's all this money coming from? And I think this gets super interesting. But for comparison purposes, I think we just start with the dollar and say this is where the dollar is right now. And this is from Yardini, and a bunch of these slides will be from Yardini. And if you don't follow his stuff, I'd strongly recommend that you do, even his website. A lot of stuff he puts out there for free. The guy's been following the market for at least 5 decades at this point, and his stuff's really good and just objectionable data. Anyway, I have no affiliation with the guy, but you should be paying attention to when he puts something out. So we can see where we're at. So let's look at this argument about .com. All right, so here we are. And that's not really the same thing. Okay, how about the great financial crisis? Well, we were down here in the 80s. All right, that's not really the same thing. So we'd have to say that we're in the median. You could argue that we're in that mid to late 90s phase, which is really what I've been preaching that we're in for some time. But that's where we are with the dollar. All this talk about the dollar's dropping, everything's going to hell in a handbasket, excuse the language, but there's no other way to say it. It's just a bunch of nonsense. You're back at the same exact level that you were 10 years ago on the dollar. Now, if I told you that the U.S. is attracting more capital in the world from foreign investors, you tell me that I'm nuts, right? Over the past 12 months through May, the U.S. net capital inflows to private plus officials' foreign accounts totaled $1.76 trillion. When we discuss PE, we have to think supply and demand. You have to think that there's only so many names outstanding. If everybody's trying to buy a name, how is that going to work out? Well, net capital inflows, total private plus official, trillions, 12 months. Look at where you're at. There's nothing even remotely close to this. What did it? Well, we got some kind of certainty on the election, and then it ripped. Right? And you can just see and this was obviously when did they sell down? And if you actually time when this sell was, it's when the market dipped. They got out of our market. We have an election. They have a certainty, and then we go from there. It has, to me, with whom got elected, you could argue that point. But this is the power of certainty, and it's why I started by showing you that graph of certainty. Oh, they have a president. If this president's going to do X, Y, and Z. This is the way he's leaning. If someone else got in, that's how they're leaning. And then once they know, then they know how to put the capital to work. Really important that when you start discussing PE, could it get more expensive? Could it not get more expensive? 100%. If you have all this money that's pouring into the country, something's going to get more expensive. And most likely it's going to be risk assets. And to be clear, where is it coming from? U.S. net capital inflows, private versus official. It's not coming from countries. It's coming from private citizens. Now, this money that's coming in could be going anywhere. It could go into crypto. It can go into money market accounts. It doesn't matter. They've gotten their certainty. Once they got their certainty, they just poured money in. And it's not from government agencies. It's from the private sector. Can you grow into a valuation if the valuations are high? And we're not even going to get into the PEs yet. We're going to say that for the end. But I want you to wrap your noodle around a couple things. This is first quarter, second, third, and fourth quarter. And obviously, we have to see what comes out. But where are we right now? Well, this was first quarter, and this will show you from 24 to 25. Well, how did second quarter go in 25? Well, just to be clear on this is what you were predicting. This is where you came in. You're at 10.5% versus the 3% that they were predicting. They were predicting a bloodbath. They were predicting stagnation in the first quarter. They got it. Look at what they're predicting in third and fourth quarter. They're already starting to turn up. And this part's important. Better than expected earnings report by the Magnificent Seven contributed better than expected earnings. We all know that. First quarter earnings rose almost twice as fast as was expected just before the earnings report season. Second quarter growth rate may be on track to be 3 times greater than what we expected. So the growth is there across the board. What we have to understand is that can you grow into those valuations? The answer is yes. What's going to decouple this entire market if this growth slows? If you see any earnings growth slow across the sectors, meaning software, semis, anything, they're going to get out of the way immediately at any sign of it. And we can talk about what happened on Friday with semiconductors. They will just sell down and then ask questions later. Now, when we get to PE, you have large cap, mid cap, and small cap in Mag 7. Just to look at the PE, everything we're looking at is on a forward basis. Again, forward. We're going to go back and look at a trailing basis at one part in this, but this is going forward. What they're telling us right now. And we can see that the Magnificent Seven are actually cheaper now than they were in 2020. Considerably cheaper than they were on a forward basis. And a lot of people are missing that, and they're looking at this percentage of how high could they go. They're asking the wrong question. The question really is, how far could the valuations be stretched? So if we look at the Magnificent Seven right now, and they are growing faster than they were growing here, it's realistic to assume that the PE can still expand. If you take a look at the large cap names on where we're at, here's large cap at 22, and if we come straight across and look at large cap right in here, it's got a drawing tool for a second so you can see where I'm going with this. So if you're right here and you're coming across in this area, what is that telling us? Well, that's telling us pretty clearly, let's make this a little bit better, that you're at the same level in large cap that you were back in 22. The Magnificent Seven is not. You're not even close to it. Really important distinction there. And then if we take a look at mid and small cap, we can see why there's so much interest there. Why are people looking at small cap? For what reason? Well, when you start looking at the mid and the small cap, you're down here at this 14, 16. Look at where you were in 2021. Now, you're at levels that if you just came across, they're historical low levels, going back 20 years for that sector. The S&P in general, right now at a historical low level, you just draw a line across, the answer is no, not even close. Not even remotely close for the S&P. Historically, the S&P in and of itself, this is high. And we can see that. It's at the same level that we were before on the large cap side, but not the Magnificent Seven. Really important distinction. So can we grow into this? That really is the debate. I think there's enough money behind it, but we need it to all expand. And there's some cracks, and we'll talk about that. But from a fundamental standpoint, the cracks are really going to be on the earnings front. Now, I'm not the biggest fundamental guy. I like looking at it from a perspective, but the bottom line is I look at it from a supply and demand standpoint. In other words, if you have too much supply and there's not enough demand, stocks are going to drop. If there's too much demand and there's not enough supply of stocks are going to rise. The metrics in which those happen on a larger scale are, the equity risk premium, things along those lines, which we've gone over numerous times. One thing that I do look at, and I do like a lot, is the PEG ratio. And I like it because it's simple and it makes sense. And if you think about it this way, all you're really doing is you're buying the stock at its growth rate In other words, what we're seeing here is real simple. They take the PE of the stock and they divide it by the growth rate, whatever that growth rate is. So they'll take the PE of the stock and then they'll divide it by the growth rate. Very simple concept. And that's when you get this number, whether you're below 1 or above 2. I could save everybody a lot of time. Whenever you're in a situation where you look at the market, pardon my voice, look at the market and you're up at this 2 level, you have a problem. You're 2 times the growth rate of everything. And this is what Itchy did to us. This is how he got in trouble. And you could see the 1 here that Yardini already has marked off. And I'm going to stress again that I'd go to his website. It's free. I have no affiliation with him. But these charts, they're important, especially if you're looking at the world from a cyclical or a secular standpoint. I'm going to define the 4 ways that you should be looking at these videos in a second. I thought a lot about this last night. I know I need a life, but here we are. So when you're above this and you're above that 2, you have a problem. You just don't know when that problem's coming, and it's really important to get that. But anything like where you have these huge spikes of the PEG ratio, it's an issue. The problem with the PEG ratio is, again, it's earnings. And this is how I learned, and it's done me well over the years. But if you're buying something and it's over the growth rate, you really have to ask yourself, is that the name that you want to be in? This is why when earnings surprises come out, people look at those names and they want to get involved. It's also why some names will lag when others won't. But for our standpoint, and I'm going to spend a second here and show you what the Mag 7 look like, just so you can see where they're at with their ratios and why some are more important than others. But if you look at this, you're wedged in and you're right at that 1.415 level. And if we go back and take a look at this, historically, we'd have to say that's pretty much where you've been. Now, does this mean that, you're going to have a recession or you're going to fall apart because the PEG ratio is some area? No, not at all. A matter of fact, if you take a look back during the great financial crisis, you were nowhere near even above what I would consider average when that started to crack. But what will happen is stocks start getting more expensive. Well, when stocks start getting more expensive, you start looking for stocks that are trading at or above their growth rate. For example, in front of us is a PEG ratio graph with 2025 estimates. And it's a simple graph taken from all the analysts that are out there. And what I would just show you is that by looking at this ratio, you can see who's the most overvalued and undervalued out there. This is one of the reasons why I always say to people when and I'm laughing, but they're always like, well, what would you buy? And I always just state, I just would buy NVIDIA. And they're like, even here, it's too expensive. What this does, and you can look up PEG ratios with any sector, any industry. You can then drill down into it. It's a great way to find names, but it really boils down to the earnings and whether or not that particular earnings has even caught on or people are aware of it. And that boils back, pardon my voice, to that whole reflexivity that I've talked about in past videos, expectations versus outcomes, right? Especially when these things are priced like this. And the reason it's priced like this, for example, NVIDIA is priced like this because people keep saying it can't sustain itself. There's no way that this could keep going. They said that about Amazon 20 years ago. Personally, I think it's the numbers that people can't wrap their noodle around. I think they have a problem with the numbers and the size and the scope of the company. But nevertheless, if you look at this and you were buying based upon valuation, you would have to say Tesla is the most overvalued out there and NVIDIA is the most undervalued out there. Now, before I show you fundamentally how to use this to your advantage, take a look at this. I did this and it's just 10 years of data. And it's very simple to look at this and say, where have we been over the past 10 years? And the way that I view graphs like this are super simple. If I look at something like a NVIDIA, I'm at 0.2 on a PEG scale, or 2 rather on a PEG scale, pardon me. And we could see that we've been up at 2.5. We've been as high there. And what are we seeing happen here? The stock's going higher, but as the stock's going higher, what's happening? As the stock's going higher, it's actually getting cheaper. So when we look at something like this, it's very easy for us to say, hey, we're not even at fair value if we're trading at historical growth rates. This is how I usually find names. If someone said to me, fundamentally, how do you find names? The first thing I'm looking for is it trading under 1 times PEG? If it is, it's a no-brainer, as long as the growth is there and we think the growth is going to historically go up. Then if we look at something that continues to drop, for example, if you look at something like, we could say anything we want about Amazon, but Amazon historically is getting cheaper as it's going higher. And that's important because they can go into these growth. If the growth starts to slow, people will get out of the name. If the growth starts to expand, they'll get in the name. What I find fascinating about charts like this is that you could then go through it and go, well, why are they selling Microsoft? And you're like, well, Microsoft on a PEG basis is actually getting more expensive, meaning it's trading way above its growth rate. Whereas if you look at something like a Apple, for example, that we look at Apple and say, well, the PE, it's the cheapest, in the group, or it's this or it's that. Is it the cheapest in the group? And you start looking at some of these other ratios, and it really gives you an understanding on where you're at. And I can't stress that enough. If you look at something like a Meta, it'll explain what's going on there. So the growth better be there on those names. And if it's not there for something like a Meta, you're going to have a real problem on your hands. I think that this is probably the most undervalued fundamental tool that's out there. And it's definitely one that institutions look at. And this is one of the ways that I would use it, and I think it makes a lot of sense. And to be clear, this is talking about cyclical or secular. And I'm going to break down 4 key concepts of how to view time and how to view these videos in a second here, because this is one thing that I'm seeing I could do a much better job of. But if we look here, the 1-4, if you looked at something like the Mag 7, you'd go back to it and go, I only want to buy stocks that are cheap. Well, PE or PEG. For me, it's the PEG ratio. So I would look here and go, the only names out there that I would even consider buying that are in the Mag 7, if I'm this kind of investor, is going to be NVIDIA and Amazon. But then I'd have to look at it and say, is the growth slowing or increasing at Amazon? Or is it slowing, increasing at NVIDIA? And in and of itself, that helps make that decision. But there's ways that you can then take this and turn it into, and I'll show you how to look at this from a pair trade and relative trade perspective. Let's say that you're an investor and you think the market is way too high. You would look at something like a NVIDIA and say to yourself, yeah, I like it, but the market's too high. Well, if we take NVIDIA and then we divided it by the SPY, meaning long NVIDIA and then short the SPY in case the market comes in, we could then go out there and say, all I'm doing is taking stock risk. I'm not taking index risk because I'm short the stock or I'm short the index against the stock. So let's say you put $1,000 in NVIDIA long and then you were just short the SPY. All you're going to get is not index risk. You're going to decrease your index risk and you're going to get more focused stock risk. I don't want to get too into this because I could do a whole topic on pair trades, but let's just say that, okay, well, here's from the breakout of everything. And we broke out to that level. What's that yielded you? Well, that's yielded you 15% in 51 days. Okay, great. Let's say that you think that the market's going to go higher, but you think some of these names are overvalued. So you would take something like NVIDIA and divide it by Tesla and say, I'm going to take the cheapest of the Magnificent Seven and I'm going to take the most expensive. And now you're not hedging out risk. You're obviously increasing company-specific risk. You're not hedging anything out, but you're saying, I think that the PEG ratios, the PEG ratios are going to wind up putting themselves in a position where they're going to come in and they're going to get more centralized, meaning that NVIDIA's PEG ratio is going to go up to 1 and Tesla's probably going to come back down to something more realistic, like a 2 or a 2.5. Or let's just say it's going to come down to a 1 as well, just to make it simple. And that you felt this way since, I don't know, we'll say since the beginning of the year. So we'll go to January here and just mark that off. All right, you'd be up 67% on that trade. And all you're doing is saying to yourself, Tesla is the most expensive of the PEG group and NVIDIA is the cheapest. And really, as long as the growth is there and sustainable, you're good. If the growth of Tesla explodes and they grow into that PEG ratio, that means the PEG ratio would actually drop. Then you're going to have an issue. Same thing with NVIDIA. If NVIDIA can't deliver, but what this does is it hedges out the risk of individual names, and it also hedges out the risk of expensive versus cheap. When we're showing these videos, or when I'm showing these videos, there's 4 very specific ways that I look at the world and the breakdown of the world. And it's real simple. It's tactical, strategic, cyclical, and secular. So when people look at these videos and I show stuff, they're looking at it and saying, oh, well, this didn't happen on Tuesday. Well, that's tactical. And what I think is helpful is to understand where you're at with these. So I want to just go through this very quickly. But tactical is days to a year, year and a half. And for day trading, that could be hours or days. Swings, it could be days or weeks. Tactical asset allocation could be 1 to 6 months. When we look at something from a cyclical standpoint, we're looking out days in some cases, but very, very rarely. But you're getting to that, oh, what's this business cycle that we're in? What's that economic cycle that we're in? What is the sector rotation that's going to happen over the 6 months? Meaning home builders or not home builders. You can't buy home builders on Friday and then think that they're going to go up, and then by Tuesday you're blowing out your cyclical secular rotation or your cyclical sector rotation. Doesn't make any sense. You could if you were tactically looking at doing it for a day trade, but if you think that they're going to cut rates and you're looking out for sector rotation for 6 months from now, you can't care what happens on a Tuesday. Strategic asset allocation, you're looking out 5 to 10 years, you're following a long-term theme. So if I'm following a long-term theme, let's say like AI, I think that theme's going to play out for 3 to 7 years. Corporate planning, they usually do corporate planning on an economic cycle. But the important thing about this is based upon what you're doing, the strategic could be different. So if you're looking at a long-term theme versus an asset allocation, the definition of extreme or the definition of strategic could actually change a little bit because they're going out a decade. Whereas long-term themes, they're going to play out a little bit over 1 or 2 economic cycles. Hopefully you're getting this, but it's super important to get because when I say, oh, the video is cheap, I'm looking out years and you could be looking out for a week. And then understanding where you're at makes all the difference in the world. And then you have secular, demographic shifts, 20 to 30 years, technology revolutions, 15 to 20 years. For example, look at the internet. In 2000, we had this huge blow up. Back in the day, this huge blow up, right? And no one was ever going to use a website ever again by 2001, 2002. So when we look at something like secular, and you think of demographic shifts from the boomers to X, Generation X, Z, whatever. Technology revolutions. Think about the technology revolutions that you could go through history from a fax machine to email to getting rid of the buggy whip. And think about how long they actually took. And then, of course, societal changes, the hippies, all that stuff. And why is this important to spend a couple of minutes on? Because if you're looking at this, and we're going to break it down into different categories within those categories just for a second. But if you're looking at this and going, well, I think the video is overpriced. Do you think it's overpriced for a couple hours, a day, a week, a month, a year? They're the questions you have to ask yourself when you're doing these trades. And that's super important. We can overlay this on any stock, and we're going to do that. Just to give you some examples. But event-driven plays could take out for weeks or quarters. Tactically, just day trading could be hours or days. Strategic asset allocation, long-term investment themes. Buy and hold investing strategically is 5 to 20 years. Retirement planning could be 10 to 40 years to be strategic. These will overlap. The ones that overlap the most are going to be cyclical and strategic. And the reason for that is because when you're looking at it strategically from more of a fundamental standpoint. Cyclically, you're looking at more of it from a cycle standpoint. Hence the word cyclical. Got it? Okay. So business cycles, recession to recovery. Economic cycles, full expansion. Sector rotation, 6 months to 2 years. I think the home builders are going to go up. I'm not just giving you an example. I think the home builders are going to go up. I don't know if they're actually going to go up or not, but if I had to tell you another sector rotation that is cyclically going to happen that I think goes into a secular bull market is I think crypto cyclically is going to have a pretty interesting ride over the next 6 months to 2 years, considering what the administration's doing. Secularly, if you think about where it's going to be around in 10 years and how the demographic and technology revolutions are going to shift, you'd have to think that that technology is going to be around in one form or another. The best way I can explain this, or give you just an example, and you can do this with any kind of topic, but when we got involved here, we saw the earnings, we saw where this was going with AI, and we bought NVIDIA in the community back here. And I was asked a question, well, when are you going to sell that? And the answer to me was, I'll sell it when I get into a position where they no longer need the chip or the chip demand slows down. I didn't get out of this position candidly, and I did re-enter it until I was up in here. I didn't sell it right away, but with DeepSeek, I got nervous that they were actually going to slow demand because they were saying, oh, DeepSeek, we can do this with, a paperclip, 2 hamsters, and a couple chips. And everyone went, and I'm like, well, if there's something to it, it's going to be a problem. And then, of course, we got liberated. But for me, I didn't care about this or these drops because from a cyclical standpoint, I'm thinking strategically on what this is going to do as well. So you have the cyclical side of the business cycle, and then at the same time, you look at their strategic planning and going, this is going to go on for years. All we're really doing is just trying to figure out what the valuation of what they're doing is what it's going to be for years. But if I'm to look at this and you think out 5 years, 10 years, where does this go? Where does NVIDIA go? They're going to stop needing the chips. They're not going to develop the chips. Now you could have a secular change in this market like you did previously. And I'll give you a great, let's do this example. Let's look at this pig. So here's Intel. And Intel was the cat's pajamas. I mean, people don't really know this, but, well, most people don't, but Intel was part of the trifecta back in the day. And what that means is you had to have an Intel chip. Not only did you have to have an Intel chip, but you had to have a Windows computer. You had to have a Dell. There was that trifecta. Now, if you took Intel and you laid this over, and then you took AMD, you will see a secular shift in these trades. For example, nobody wanted an AMD chip, no one. And so when we start to look at it from that perspective and we go through time, let's go to, and you'll see it right here. I was going to go to the week. You'll see the shift. And why does this shift happen? The shift happens because there is a secular change in what AMD is doing. It's not they just had a great chip, their technology was better. And once their technology got better, you have that secular shift. Could that happen with something like a NVIDIA? And could it be AMD? Yeah, weirder things have happened. It absolutely 100% could be. But by understanding how you're supposed to look at these time frames, it changes everything. Because you're going out there and saying, all right, NVIDIA, I think that you're going higher long term. But if I'm in here whacking this thing around during the day because AMD had a bad day or AMAT had a bad day, we're going to get to some names in a second here, well, then that's a completely different trade, right? I'd have to look at this on what it is. And I tactically would have to say, I'm in a trading range between 183.81 and 178.90. And once you can start overlaying those with it, not only can you take this video, but also your like investment and trading thesis and go, well, this is what I think about this. And by allocating those parts to it, your trading will go up incrementally. AEO is a great example and something that I'm long and think does very well, but you have that tactical move the first day that's, that Sydney Sweeney's in a pair of jeans. And then people don't like Sydney Sweeney in a pair of jeans, so it starts going sideways. But if you looked at this from a cyclical standpoint, you have to realize people are going to buy those jeans. And if they're going to buy those jeans 3 to 6 months out, you have to think about that and go, well, this is going to be a decent earnings quarter. The next one's probably going to be decent. And then maybe they hate Sydney Sweeney jeans, right? People used to love Calvaricci's. Now they hate Calvaricci's, right? If you know, you know. So at the same time, you can profit from this. And it's no different than people buying Open, for example. There's a bunch of people buying Open that think Open is going to be the next cat's pajamas. I don't know if it's going to be. I know there's 1 billion shares outstanding, and I think it's going to have a real tough problem getting through that. But you got a new CEO, or you're looking for a new CEO. You have a bunch of people that are betting against you, right? So you have to lay that over with that whole reflexivity of outcome versus expectations. Somebody's going to get hurt here, long or short. Someone's going to get really hurt, right? Somebody's wrong. But let's say they do turn it around. And then you would look at this and go, well, tactically, this could come down to $2. But if they really start getting their act together, well, this could be $12 in a year. So it's no different than when people were looking at this from a CVNA perspective and saying to themselves, oh, there's no way that this company's ever going to come back. And once they turned the corner in here and said, hey, we're going to be profitable, and people started understanding the model, well, this thing goes, from being a zero, which I thought it was back here, I did quite well with the short, to, oh, they got their act together. Hey, this could be a problem. Since then, it's absolutely ripped. Understanding that this will change the way that you trade. I say incremental, but it's actually exponential because you're out there going, no, it's okay if it goes down or up or wherever it goes, because secularly, I'm looking at this for the long term. And once you get those concepts, you'll start looking at it differently. But what you're really doing is, and it all boils down to the same thing, and I'm going to get old school here, and we're going to go back to the stool. But if you start looking at it from a macro, a fundamental, and a technical standpoint, you're looking at the macro, and the macro is going to change the what. The who's affected by it is the fundamentals, and then the technicals. So as I've always said, when we start looking at these stools, what we're really doing is make a real big one. So what you're always doing here with these stools is, if you're more tactical, well, then you're leaning more on this leg. You're leaning more on the technical leg if you're more tactical. If you're more strategic and cyclical, you're leaning more on the fundamental leg. And if you're out there being more secular, you're leaning more on the macro leg. And so these pieces, that's why it's so important to understand what pension funds and institutions are doing. That you can't think, like when people asked the other day, like, well, why would you flip on UNH? Well, Buffett's not a tactical buyer. Tepper's not a tactical buyer. They can't get out of those names, right? So the only way that they could be buying UNH is on a cyclical basis, meaning they have to be looking at this for at least 2 to 4 quarters, or they wouldn't even touch it. Hope that makes sense. There's a lot in today's video, a lot, and I put a lot of time into it. And the reason that I do this, one is I absolutely love it, but two, there are parts of this that you're going to want to watch again. And if you utilize these parts, it's not just knowledge that gets you where you want to go, right? It's the applied knowledge. So looking at that before you make decisions and learning how to think differently, that's the cat's pajamas. S&P valuation PEG ratio is where we started. Let's go to the next slide. If we take a look at the PE ratio, trailing versus forward, do we see an issue? This is where you have to grow into it, because if you look at trailing versus forward, you kind of have a situation where do you really want to be here? I would rather buy when they flip, but they don't flip very often. So we kind of have to be aware of that. You got to add a second down here, but trailing earnings, here you are at 23.3, 22 forward. What I would say to you and looking at this is, do you have a recession or do you pull back on the market when the PE is expanding or contracting? If you take a second, look at this. You pull back when the market's contracting. If you get a contraction of a PE, that's when you're pulling back, not during PE expansion. And that's because of the PEG ratio. I thought this was super interesting and I wanted to share it. So you have forward earnings on corporations above a 20 PE and below a 20 PE, looking at it on a weekly basis going back 20 years. We would look at something like this and we would say that this is secular or cyclical in nature, that's how we would use it. So when we're looking at this, look where you are here on the percentage of names with a 20 PE, 45, and you go back and go, well, that's .com. Well, that's also 18 before we got liberated the first time with China. Remember the first time with tariffs? Remember, Jerry? And so then if we take a look here, we're going, okay, well, 10. All right, well, that's not crazy, but only 10% of names are below a 10 PE. It's also kind of interesting when you look at these movements. I think you have to get somewhat closer in here, and I think that means that the breadth of the market actually is going to get better. Technically, we're not seeing that yet, but I think that is where eventually this heads. And I think it heads by diversification into different sectors, which actually means eventually the PEG ratios of like the big dogs, like the Mag 7, I actually think they get better. I think the video steps into it, but I think the other ones actually get a little bit better. As far as tactically on the week, I think there's a couple names that are worth paying attention to. RBLX, they said for a long time there was an issue here, and the Attorney General of Louisiana is looking into the company. This is pretty much the first crack. A lot of people are just watching the bounce of something like this. Usually what happens is so many people have been short for so long and they've gotten absolutely decimated in that short that they're going to take some profits. Now, whether this gets blown off or not remains to be seen. But the issue with something like an RBLX is if you start to see more states pile in. You start to see more states pile in, you're going to have a real issue. But for now, you're holding that 55 level right here, and it's definitely something that should be on your radar. The other one that I thought was pretty fascinating is UNH. You saw Tepper, you saw Buffett, they stepped in. I don't really care about some of the other guys that are buying, but if those guys are buying, there's just not enough turnaround time for them to get out of something like this. So when they step in, you have to think about not only their connections on how they understand what's going on in the world, but you have to think about it that they can't get out. So meaning if there's another shoe to drop, they have a problem because there's literally millions of shares out there that they're going to be holding. They can't just move. This leads to a very interesting situation where you know they did their due diligence. You don't know if they're right, but with their connections and their research departments, you would think that they feel that at this level, it does make sense for them to start accumulating the stock. I was very surprised that they both did, because it means to me that they don't think there's another shoe to drop with UNH. Because if they felt there was, or they feel that they're able to navigate it. Even if there is another shoe, they feel that they're able to navigate it, and it's not a world ender for UNH, which is interesting. And that definitely has my attention. It is something that I did start buying, just to disclosure. But I would pay attention to it. Does it mean that they're all going to go up? Well, you're starting to see names like CNC start lifting, and you start watching the XLV lift. I wouldn't go out there and say that these guys went out there in their 13 Fs and started buying the entire healthcare department. Could healthcare go up because of this, because they started buying? It could, but the idea that all of a sudden that these things are all going to just miraculously fix themselves because of this, that's not how I would view it. I would view it as thinking about how Buffett and Tepper look at the world and say, Buffett's looking out 5 to 10 years and he feels that it's okay to get involved here, and he's got a good price point to start. And Tepper's looking at the same thing, but on a shorter time frame going, well, this makes sense over a year or two for us to get involved with. Very different than saying, hey, these secular changes that are probably going to happen in healthcare that's a very different kind of bet. So I think it depends again on your time frame, and we've gone over those time frames ad nauseum. This was the name that really shook semis, and this is exactly what I mean when I say that you're really on that razor's edge right now, where you're looking at something like an AMAT and you're wondering, why did semis do what they did? Because everything's on earnings and everything's expensive as we went through it. It's not a cheap market, it's an expensive market. And the premise is that the earnings are going to grow into the market. When you have something like AMAT that comes out and literally is a dumpster fire, you get the shooting star, it couldn't even hold the level. What we saw going across the board was just sheer get me out. This is way worse than we thought it was. Even names like Lam Research, which crushed recently, and this was something that I really wanted to buy when it was breaking out, but they all share the same brain. So once it cracked, all these semi-cap names, they all came in, and they all came in hard, meaning KLAC, all of them. And I'm really surprised that you didn't see no bounce whatsoever. These black Marbuzu patterns, which is just where you open up and just straight down. And this is a concern of mine because they really just seem to get out. Now, do they do that with NVIDIA, which is coming out in earnings 2 weeks? I don't know, but if we really take a look at how the end of the day went, it wasn't really fantastic. So I really am curious about how they played this out. We actually took out the lower low, and we really took out this area in here, which I've been watching, and it's been a great trading area for a period of time. You could actually see it for yourselves, but they actually break you down in the morning, like pretty much every single morning they were doing it, Tuesday, Wednesday, Thursday, and then bouncing you back up, and then you have that high up here, which we've hit over and over again. And the question is, are you starting to see a change in trend here ahead of this? I don't really care if we see it ahead of it. The question for me always is what happens after. People love to hate this name, and right now, if we look at the structure of the move, they've been walking us down. And so this is kind of setting up a little bit, and I'm wondering if we're going to come in before the number. And people just de-risk. And if you think about it, from where you were at 142 to 180, you're up 40, 45 points. Do you de-risk before that event? If you're looking at RSI, you have to say that it's a possibility. If you drop it to here, and again, we're talking tactically, right? If you look at it from this perspective and you start realizing that, you did close below the 5, and the 5 is up top, and the 8's starting to go higher. We're starting to point down on the 5. It's been a long time since we've seen that, so we have to get up and above it. Remember how I look at these, when you see that, you just kind of put the brakes on, and it's been a long time since you've had to really concern yourself with a declining 5-day moving average on the video. So that is definitely something that's on my radar. Another thing that stood out to me that's worth bringing up is that Apple could not rally for the first time in a long time on the bounce. And we have moved pretty far, pretty fast on it, but this is something that is, in my opinion, worth paying attention to. I also think that you're starting to look for those next growth names. And some of these names really did move. Like, for example, Wolf with this contract, we saw a huge move there, and that move was very well received. I would watch that next week. Another one that I would definitely watch was Circle. I was really surprised that 130 held, because that's where they did the secondary, and that name held. And another name that you guys probably aren't even watching, but take a look at this LEU when you get a chance and watch how it acts right around that 55 now that secondary has priced. Let's just show you where that's sitting. You want to make sure that you get above that level, but that's also pretty interesting. Some of these other names to me, they just can't get out of their own way. And when I see this, it just makes me very, very cautious because as I said before, if you're looking at it from a tactical standpoint, when you crack like this and you're expensive, it does become an issue. And take a look at something like a Microsoft over the course of the month. You've only had 2 up days. That's it. And when we're hitting these new highs on these names, for example, like Meta, you're seeing these massive rejections and inability to rally. That is always somewhat a concern of mine when the breath looks the way that it is. But I do think you're going to have enough volatility for those that are short-term traders that this is just going to be some great weeks ahead from a trading standpoint. I think you have to get through, I'll leave it at this. You have to get through Jackson Hole. You have to get through NVIDIA's earnings. And once you get through both the Jackson Hole speech, which is coming up, and NVIDIA's earnings, which is on the 28th, we'll get a better sense of what's going on here. That's it.